Today's aim at pre-market. Yesterday, as the European Central Bank's annual Sintra forum concluded, the sell-off in the U.S. bond market, triggered by the rising possibility of Trump's election victory, quickly subsided. Market data showed that U.S. Treasury yields across various maturities fell overnight. Specifically, the 2-year Treasury yield fell by 1.4 basis points to 4.752%, the 5-year by 3.3 basis points to 4.399%, the 10-year by 3 basis points to 4.438%, and the 30-year by 2 basis points to 4.607%. At the forum, although Federal Reserve Chairman Powell did not specify the exact timing of the first rate cut, his remarks revealed a strong inclination towards cutting rates and reducing inflation, with the goal of bringing the inflation rate down to around 2%. In addition, data showed that the U.S. core PCE inflation rate in May fell to an annual increase of 2.6%, ending the previous 3 months of stagnation. At the same time, Chicago Fed Chairman Goolsbee, as a consistent dove, once again expressed support for rate cuts on Tuesday. These signals indicate that a rate cut seems to be a high-probability event. Influenced by Powell's speech, U.S. Treasury yields fell further in trading, and the U.S. dollar index also touched an intraday low. In terms of the stock market, both the Nasdaq and S&P 500 indexes set new historical closing highs. The Nasdaq closed above 18,000 points for the first time, and the S&P 500 broke through the 5,500-point mark for the first time. However, despite Powell's remarks and macroeconomic data pushing for a slight decline in yields on Tuesday, political factors and the uncertainty of government deficits under Republican control still provide overall support for yields. This indicates that while the market has a strong expectation for a rate cut, other factors are also influencing investors' decisions and the direction of the market. In this uncertain market environment, I suggest that everyone focus on financial stocks and real estate-related stocks. The financial sector benefits from the profit growth brought by Trump's policies and the loan issuance stimulated by rate cuts. The real estate sector benefits from low interest rates and economic growth, with rate cuts reducing mortgage rates and increasing market purchasing power. You can ask me like this in AIM, and I can dig up the latest investment opportunities for you in real time. Tonight at 8:30 p.m., the U.S. government revealed a key piece of employment market data. The number of first-time applicants for unemployment benefits this week is 238,000 people, slightly higher than the 235,000 predicted by economists. This slight increase, though not significant, may imply that layoffs or hiring activities have slowed, which could have an impact on the economy. However, in stark contrast to this slight rise is the exceptionally strong job vacancy data for May, released on Tuesday this week, which exceeded market expectations. This data demonstrates the vitality of the job market, contrasting with the market's concerns about a slowdown in employment, bringing a glimmer of hope for the economic outlook. Historically, a slight increase in the unemployment rate, especially rising more than half a percentage point from a recent low, is often a harbinger of economic recession. But judging from the current situation, the slight increase in the number of first-time applicants for unemployment benefits does not seem to show obvious signs of economic recession. Considering everything, if we look solely at the data from this unemployment figure, its impact on future monetary policy may not be significant. Policymakers, when formulating policies, still need to take into account a broader range of economic indicators and market dynamics.